Hi there, everyone. Thank you for joining us today. My name is Marcia Butler. I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars, such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation. Attendees are muted, but we do encourage you to ask questions using the chat box and also make comments. Let me go ahead and make sure that is turned on. All right, it is. The presenter will answer those queries during or after the webinar presentation today. We do have a question and answer portion of the webinar, so we will be addressing individual questions at that point. If you ask a question and we're not able to get to it, please make sure to leave your contact information in the chat box, and we're happy to reach out to you after today's event to make sure that gets addressed. Again, we want this experience to be as educational as possible, so please don't hesitate to ask for clarification or expansion of the material. We'd love to introduce you to our presenter today. Let me go ahead and get that up. My goodness, I'm not having luck with the computer today. Now we're all right. Our speaker today is Alex Walker, and Alex first discovered the world of investments at the age of 14 and would spend hours after school screening stocks and calling companies in which he was particularly interested. He couldn't help but become fascinated with future technology, specifically with respect to which industries would be running the economy 20, 30, and 50 years into the future. Inspired by his family's struggles during the 2008 financial crisis, Alex chose to pursue a career in financial planning. He has a bachelor's degree in personal financial planning and spent 3 years learning the industry at MassMutual and joined Catalyst Advisors in April of 2020. Alex thrives off the interaction with his clients and takes great pride in the formation and execution of a financial game plan to help each client get the most life out of each of their dollars. Alex is an investment advisor representative, holds various insurance licenses, and is a certified financial planner professional. And Alex, I'm going to go ahead and turn the time over to you.
Awesome. Thank you, Marche, and thank you all for being here today. I'm very excited about this topic, financial planning with a variable income. Building a plan when you don't know exactly what you're going to make month to month, quarter to quarter, year to year, it's really a completely different animal than someone who's living on a fixed salary. And this greater complexity makes financial planning just that much more important. So this is why I've focused my practice here. Today, a majority of my clients live on a variable income. So before we get into anything, we'd love to hear a little bit from you guys, what kind of professions you're in. So whether that's a sales role, an entrepreneur, you're an executive with a bonus heavy comp structure, maybe you're a realtor, would love for you to jump into the chat and let us know what kind of roles you guys are in. And the first thing we're going to do is talk about challenges and opportunities that come from having a variable income. So today we're going to identify a few of these challenges and opportunities so that you can better adapt to the challenges, plan for them a little bit better, and capitalize on the opportunities as well. Now, whether you've got a standard income or a variable income, the basics of a good financial plan really are the same. You need to have a budget. You need to have a plan for saving for financial goals. Now, that might be short-term stuff, buying real estate, taking care of debt, planning for education for yourself or kids, planning on buying a business, growing a business, anything like that. You need to have a plan for saving for retirement, and then you need to figure out a plan to navigate taxes along the way. So while these topics are the same, whether you're on a fixed income or, stable income versus a variable income, how you approach them should be very different. Now, all good planning starts with a budget. Cash flow is the fuel that drives your plan. As a variable income person, we need a plan both for the low income months and the high income months. And ideally, we need a budget that really smooths that out so that maybe you or your household doesn't feel that pain as much on the low income months, doesn't feel the elation maybe even as much on the high income months. We want to kind of smooth that right out so that your household doesn't necessarily feel whether it was a good month or a bad month.
Alex, I have a question here. So I'm assuming that you see kind of what people would naturally do without this kind of plan. What is kind of the general, maybe no plan approach to a variable income?
Well, the no plan approach really is a no plan approach usually. People have a general idea of what they're spending, and then they figure out the rest afterwards. So they might put the difference on credit cards. They might eat into savings and then hope they can catch up on it later. There's really usually not much of the plan is usually something like, I'm going to make enough money to make up for it, is where the planning stops. And so we want to be a little bit more systematic about it than that.
All right. So taking away some of that risk.
Right. Yeah, we want to know the outcomes and have a plan for them rather than flying by the seat of our pants and hoping things work out.
Mm-hmm.
Yeah. So before we kind of get into the actual process of a good variable income budget strategy, there are a few things first that we need to know and maybe have established. So one is an adequate savings cushion, so an emergency fund essentially. I do believe that variable income folks need to prioritize this more than others. So the general rule is 3 to 6 months, and I think variable income folks should lean into that 6 months rule. And now an important distinction here that I see people get wrong pretty often is that this number is based on your emergency budget, not necessarily how you're living your life right now. So imagine that you lose your job, take a big pay cut, something like that happens. How could you sort of cut back and live your life while you figure out what's next for you? So for most people, obviously it depends on where you live. An emergency budget in St. Louis is going to be completely different than in San Francisco. But here in the Midwest, the number is usually $25,000 to $35,000 is a good emergency fund number to have. The next thing we need to know is your baseline income. So that's essentially kind of the minimum expectation of what you're going to make every month. And this is going to look completely different depending on the role you're in. So some people might have a base salary where they do have a minimum check coming in every month, but then they've got monthly commissions, quarterly bonuses, annual bonuses that make up that variable component, compared to somebody like a realtor who might truly go a month, 2 months, 3 months with a full zero in the income box. And so that baseline income helps to distinguish kind of where you fall there, and we'll change how we plan. And then once you know your baseline income, you know what your monthly expenses are, you have the adequate savings, then we can start to build a plan for a high income month versus a low income month. So we're going to go through the process here in a second, but the general idea is how we're going to smooth this out is using that savings as a buffer between the low and the high income months. So most people who live on a variable income, if they have a bad month, they're living in a deficit. So if they have a bad month, they're probably going to spend more that month than they bring in, and then they're going to hope to make up for it when they have a good month. And that's perfectly fine, but we want a real plan and accounting method to make sure that we pay ourselves back for those low months. So what we're going to do is in a low income month, let's say our income comes in $500, $1,000, $2,000 under what we're going to spend, rather than trying to cut back or, oh, I'm not going to save this month, or no, we're not going to go out to eat or whatever that item is. give yourself some grace. You don't want to change your lifestyle like that month to month. So you're going to go ahead and take that difference in your budget out of savings, record that self as a debt to yourself, and then pay yourself back when you have a good month. Okay. Then when you have that better month, okay, I've taken out $3,000 from savings over the last 3 months. I've got to pay myself back for that. And then maybe the most important part is to have a plan for the leftover. So a lot of times people get those big checks and they go, what am I going to do with it? Is it going to go towards, saving for the deck that we're putting in the backyard? Is it going to go into an investment account? Is it going to go into travel? And they kind of just decide that when the check comes. So we want to establish a plan on the front end that when that big check comes from your good month, you don't have to think about it. We've already got a plan in place where you enter the number and it's going to tell you X goes here, Y goes there, Z goes there. So we're going to take a look at a scenario so I can show you guys what this budget process looks like in practice. So we are going to look at Bailey. Bailey is married and their spouse stays home and takes care of the kids, but so we're operating on married tax brackets. They've got a base salary of $100,000 a year. After they pay health insurance and pay taxes and contribute to their 401k, they get a net check every month for $6,000. And then on top of that, they have monthly commission checks that could range anywhere from 0 to 10,000. And they've got an annual bonus check that could range anywhere from 0 to 75,000. And just taking a look at the last 5 years of income, it's somewhat predictable, but still quite a wide range. So 150, 180, 245, 210, 175. So Bailey knows, hey, I'm probably never going to make less than 150 in a year, but I've got no idea whether I'm going to make 150 or 250 when I'm headed into that year. Okay, so this is Bailey's budget. We don't need to get into all the details. That's not what we're here for today of what are they spending on car insurance or mortgage. So we're going to focus on kind of the bulk numbers instead. So we've got fixed expenses of $3,300 a month. We've got variable expenses of $1,700 a month. We've got a little miscellaneous box there as kind of a catch-all for the, there was an oil change this month, or we took an extra dinner out, or the kid needed new bat for softball season, right? So that's kind of your catch-all box to account for the ebbs and flows. And then Bailey has already done some financial planning. So they've got some fixed savings. So they're putting $500 every month into a savings account for a down payment on a lake house. They're funding their Roth IRAs. They're funding another investment account and then a 529 as well. So if we take a look at the baseline in the middle here, you'll see they bring home, even in a month with no commission checks, they've got a baseline income of $6,000 a month. They pay their fixed expenses, they pay their variable expenses, they contribute to their fixed savings every month, and they end up with a deficit of $750 a month. So like we talked about before, rather than Bailey having to look at that month and go, oh, had a bad month, what are we going to cut back? Sorry, we're not going out to dinner. Let's see if we can, cancel that trip that we were going to take this month or whatever it might be. Bailey's not going to think twice about it. When that check comes in, he's going to take $750 out of savings, move it to his checking, allow himself to live his normal life, and simply record that as a debt to themselves. So this is a low income month, and now Bailey has moved money from savings and they've recorded that as a debt to themselves. Okay. So next we're going to take a look at what does Bailey do in a good month. So now next month came along, Bailey did all right, had kind of what Bailey would consider to be an average month, and had a $5,000 net commission check. Now we had a $750 debt last month. There's still that $750 deficit in the budget. So there's a total of $1,500 that Bailey needs to pay back to savings and to cover lifestyle. And we're left with $3,500 to plan. Now, Bailey isn't month by month making this decision of what am I going to do with that $3,500. Bailey's already taken the time to think about, okay, what's important to me? Where are our priorities? Where are we at in life right now? And whether I have an awesome year this year and make 250,000, or I have a bad year this year and make 150,000, when those commission checks come, how am I going to allocate them? So Bailey's made the decision that they're going to take 50% of their kind of bonus income and put it towards the savings goal of saving for a down payment on a lake house. They're going to take 10% and put it towards catching up for retirement or planning for an early retirement. They're going to take $700 and put it towards other investments. And then they're going to take $700 to do whatever they want with, right? So that might be the splurgy stuff of they go buy themselves a new pair of shoes or a new bag. Maybe they set that aside as extra travel budget for the year, but they're going to take that and if you're doing this right, that money really shouldn't be saved, right? It gives you that permission to go, I know I'm doing all the right things. I've got the right process in place. I'm going to go blow this $700 on whatever the heck I want and not think twice about it.
So I'm just thinking about this as I'm assuming that some people will see that extra $5,000 and say, hey, I can blow, 4,000 of it. This gives you permission to blow some of it without sabotaging your future.
Yeah, and those numbers are totally different for everybody, right? So some people feel like they're already way ahead of the game from a savings and retirement standpoint. So maybe they blow 70% of the check and only save 30 of it. Someone else might feel like they're way behind and they want to save 100% of the check. It's different for everybody. And there's no right answer here either. It's about what's important to you and being thoughtful about the purpose behind the dollars rather than just randomly doing things and then having regret either way. I see it all the time where people regret spending too much, but they can regret saving too much too, as crazy as that sounds. And they wish they would have done more fun stuff in their 30s and 40s rather than being worth $10 million when they're 70. They go, I should have lived a little bit more, right? So being intentional about what's important to you and what you're going to do with those dollars rather than just flying by the seat of your pants and living with the results down the road. And the next thing, this really isn't all that different. It's just going to speak to the process of once you've got this set up, it takes all the thinking out, which is where the thinking on when we think about things in the short term, that's usually when we mess up, when we make impulsive decisions. When we think about things from kind of a long range view, we tend to make better decisions that way. So once Bailey has this process set up, he now gets they get their annual bonus check of $42,000. They don't even have to think twice about it. It's not, oh, what are we going to do with it? It's plug it into my system. It's going to tell me what to do, right? So $21,000 goes towards the lake house. Awesome. We're probably getting close, maybe another year, and we're going to be able to buy that house. $4,200 goes to retirement. Maybe that's a Roth contribution for the spouse or something like that. $8,400 to other investments. And then $8,400 is the blow it budget in this scenario. So maybe that's the travel budget for the year. Maybe every year Bailey goes, you know what, if I don't get an annual bonus check, we're only taking one trip that year. But if I get my annual bonus check, that $8,400 or $3,000 or $12,000, whatever that number winds up being, we're going to spend all that traveling in the following year. So the customization to this is endless. You set it up around your priorities and what's important to you, but the process is going to look the same regardless of what those priorities are. Obviously, this can look totally different, right? Going back to the different levels of variable income and the different roles you might be in. So that baseline income here certainly helps make this thing that much smoother. If you've got real 0 months, this is going to be a more complex planning. We might decide that, hey, maybe that savings buffer needs to be a little bit bigger. But this process should really be able to be applied to any degree of variable income and any variance in priorities and work just as well for any of those people. So now that we've got kind of the budget under control, which is at the end of the day, if you don't have to count every nickel and dime, but if you don't have a budget, it's going to hold back the rest of your plan. So now that we've got the budget under control, the next question is how to save for retirement and other goals. So what's the right way to allocate those extra dollars that we have? A lot of what makes a good decision versus a bad decision here is centered around tax strategy. Ideally, for variable income people, it comes down to having a plan for good years and having a plan for bad years, right? So the budget is having a plan for low income months and high income months. The overall financial plan for variable income is having a plan for low income years and high income years. So we're going to take a look at kind of a few key ideas, things to think about. The level of nuance here is large. We'd have to spend a dozen hours going through every little talking point. So I'm going to give you guys a few ideas for bad years, a few ideas for good years, why they work. And then we will do a deep dive on what is a pretty frequent topic of, does it make sense for me to make traditional contributions versus Roth contributions? So in order to have a good tax strategy, there's some info we need to know, right? So the first thing is, what tax bracket are we going to be in each year? Again, depending on your level of variance in income, this might be an easy question to answer. This might be hard. So if your income varies, but it's always 120 to 180, you're pretty much going to be in the same tax bracket every year. But if your income varies from 100 to 250 or from 300 to 500, you might end up the year in very different tax brackets. So we need to identify, based on your situation, what tax bracket might you end up in at the end of the year. If we know there could be a big change there, we need to build a system that lets you defer some of those tax decisions until later in the year when we have more information. So for some of my clients who are, in that 125 to 200 range, and they don't know, A, do they want to make Roth contributions, and B, are they going to be able to? One of the things we'll do is, rather than taking that $500 a month and just putting it directly into the Roth IRA, we'll just take that same $500 a month, put it into an individual brokerage account, investment account, and then wait until the end of the year, assess the situation, and then decide what to do with that money. Another mistake I often see people making is fixating on the year to year. So they get so caught up worrying about their tax return. How do I get a return this year? How do I pay as little in taxes as possible this year? That they don't think about the long-term strategy of, how do I pay as little in taxes as possible over my entire lifetime? A lot of times when we're talking about hundreds of thousands, millions of dollars when you think about how much you're going to pay in taxes over your lifetime, and a small 10, 20% reduction in that number can be the difference between a great plan and a failing one. So we want to find that balance between navigating year-to-year tax strategy while still keeping that long-term tax strategy in mind. So just to give you guys a lay of the land of the tax brackets, and maybe point out a few key numbers to keep an eye on. So if you notice on the left side, you've got your tax rate there, and there should be a few numbers that jump out. So starts at 10%, there's no getting below that, right? Even if you make $1, the federal government's going to tax it at 10%. Obviously, there's deductions and things like that, but $0, $1 in AGI is going to get taxed at 10%. And the next jump is only to 12%, right? 10% to 12%, really not that big of a deal at the end of the day. That next jump is a big one, right? So you're going from 12% to 22%. And you can see, as a married couple, that $89,450 is where that jump happens. So what that number really is it's an AGI number, not a gross number. So by the time you take your standard deduction, pay your health insurance, contribute to 401k, maybe you've got some child tax credits and things like that, this number really is usually about $120,000 to $125,000 of gross income is where you're making that leap from the 12% to the 22% bracket. And so if you're right on that threshold, that's something you really want to be conscious of, and maybe thinking about, how can I make sure none of my dollars get taxed in that 22% bracket? And then same thing, you'll see going from 22 to 24, that's a wide range there, 89,000 all the way up to 364,000 that falls in that 22 versus 24. Same story as 10 versus 12, right? 22 versus 24. Not that you want to ignore it completely, but certainly not as big of a deal doing a 2% jump versus a 10% jump. So the next big number we want to focus on is that leap from 24% up to 32. Same story, that it happens at 364 of AGI. So what that number really is for a married couple, usually about 400,000 gross where that leap happens. And same idea of if you're right on that threshold, how do we pay ideally no dollars winding up in that 32% tax bracket? So two big numbers to focus on where tax planning becomes, I would say, exponentially more important is that gross income line for a married couple right around 125,000, and then also the line right at 400,000 are the two ones to really focus on. We're also going to take a look next at capital gains brackets. So this is on realizing a gain on an investment. So that might be on a piece of real estate, that might be on a stock that you bought. Maybe you got lucky and bought some Tesla stock a few years ago, and that worked out really well for you. And a lot of people don't know this. You're not going to see this very often, but you should be your eyes should light up when you see this 0% tax rate. That doesn't show up many places in the US tax code. So anytime it does, we want to be sure we're conscious of it. And if we get an opportunity to use it, we should be using it, right? So same threshold, luckily, as that jump from 12 to 22. It's pretty much the same at right around $90,000. So anything under 90,000 of AGI, again, for a married couple, it might be 125,000 gross or so. You can actually sell an investment, realize a gain, and pay 0% federal capital gains rates on. So, for example, somebody makes $100,000 and they've got a piece of real estate that they bought a few years ago and they're using it as a rental, but they're sick of it. They want to sell it, but they don't want to pay taxes on it. Well, they can sell that property, and the first $30,000 in gains that they're realizing is going to hit the capital gains rate at 0%. So they're not going to pay any federal taxes. You might still pay a little bit of state depending on the state that you're in, but that's a really big difference compared to paying 15 if you're over that threshold. Okay, so once you understand the tax brackets and you've got a budget, and your income ranges for in general a year, if you might make 150 or you might make 500 or you might make $1 million, what those ranges are. Now we need to have a plan for, okay, what am I going to do when I have a good year? Why am I going to do that? What am I going to do when I have a bad year? And why am I going to do that? And again, this is an endless conversation, so we're not going to dive into these individual points too much, but some key things to maybe think about. You can go to Google and look into them and how they might fit best for you. So good years means we have a higher than normal income, which means we're in a higher than normal tax bracket, which means we want to prioritize tax deductions in this year. So one of the easiest ways you can do that is maxing out your 401k or your HSA. HSA gets slept on all the time. It's the only account in the country really that's triple tax advantaged. So you get a tax deduction when you put the money in, just like your 401k, but it's also tax free when you take the money out, just like a Roth, if you take it out for the right reasons in the right way. So maxing out your HSA and 401k is a great place to start when it comes to taking tax deductions in a really good year. If you're self-employed, you own a business or you do some outside consulting and you get a 1099, as a self-employed person, that does open up some other options like starting a SEP IRA or a solo 401k to bump up those contribution limits and increase tax deductions. And then the last thing we want to look for is realizing losses in non-retirement accounts. So same story. Bailey was trying to pick between Tesla and Peloton a few years ago, and unfortunately he picked Peloton, and his $10,000 is now worth 500. While that's really painful, that's not very fun. There is a small silver lining how he can get some of that money back in his pocket. The IRS allows you to write off up to $3,000 a year in capital losses against your income. Okay, so the key being that it's against your income and not just against other gains. So Bailey could go, you know what, this Peloton stock, maybe it comes back, maybe it doesn't, but I'm going to go ahead and sell enough so that I get $3,000 in losses. I'm going to write that off against my income, which was in the 32% bracket, and essentially you get $1,000 back as a tax credit, $3,000 deduction. It was about $1,000 in tax savings at that tax bracket. And so even though he does that over 3 years, right? He 10,000, he lost 9,500. He's down to 500. But by realizing losses in good years, he's able to get $3,000 back over the course of 3 years and take what was a horrible investment and just make it a bad one, right? So looking for opportunities like that can make a really big difference when you compound them over the course of decades. Now the next question then, right? So a couple things to think about in good years, take a look at a few things for bad. So the idea is really the exact opposite. So we're had a lower than normal income year. That means we're in a lower than normal tax bracket. So we don't really care as much about gobbling up tax deductions. And we might even want to intentionally pay taxes on dollars in these lower brackets so that we can avoid paying higher taxes on them down the road. So this can be a great year to max out your Roth IRA. It can even be a great time to do conversions. So IRS says, doesn't matter what you did when you put the money in, anytime you want to, you can take your traditional monies, so IRA, 401k, traditional stuff, and you can say, hey, I'm going to opt into paying all those taxes now to turn that money into Roth money and let it grow tax-free forever. There's no limit. You could, in theory, do $1 million conversion in 1 year. There's nothing stopping you from nuts. It's certainly not a good idea. You end up paying a lot of taxes that way, but there's nothing stopping you from doing that. So taking a look at, is there an opportunity to do some Roth conversions in these lower tax brackets? And is there an opportunity to realize capital gain? So maybe you're all the way down at that 0% capital gain rate that we talked about earlier, making sure that you don't miss that year and end up having to sell something next year when you're paying capital gains. You could have sold it this year while you were in that 0%, realized all those gains, not paid any taxes, and then reinvested that money. So kind of deep. So that's the big picture, right? Hopefully that gives you a few bullet points to kind of go, and you can Google or talk to somebody and think about how they might fit into your plan. Each of those points really does require a deep dive to understand the nuance and pros and cons. So one thing we're going to take kind of the deep dive here is the traditional versus Roth contributions and how they impact you over time. So we'll go back to Bailey. Bailey's at the end of the year, and Bailey's got $10,000 that they can put into their retirement plan. And they're trying to decide, am I going to put it into a Roth account or am I going to put it into a traditional account? Okay. So the left column there is Bailey looking at, what if I put it into a Roth? So he's going to take $10,000, put it into a Roth IRA. Because it's a Roth, there's no tax deduction. So they've got to pay taxes, a 22% rate. So they're really only able to get $7,800 invested. Okay. 30 years goes by, that money grows to about $125,000. Now they're retired. They take the money out. They don't pay any taxes. They're left with $125,000. Okay. Now, instead, what Bailey could do is put that money into a traditional IRA or 401k. Now, because there's a tax deduction that comes with that, if they've got $10,000 to allocate, they actually get $10,000 into that plan because they don't owe any taxes on that money. So $10,000 invested today compared to $7,800 invested today. So that number now grows to $160,000 to 30 years from now, rather than 125. But here's the really interesting part. Bailey is retired, goes to take the money out, 160,000 comes out of the plan, pays 22% taxes. And when you look at that, it's the exact same result either way. So when we're thinking about traditional and Roth IRAs, there is no better or worse. It is purely a tax arbitrage math problem of what tax bracket am I in when I put the money in? What tax bracket am I in when I take the money out? If those numbers are the same, it is going to make no difference whether Bailey puts the money into Roth or puts it into traditional. Now, there is some planning nuance to this, that if the dollars are the same, the Roth may still be best, because now when they're retired and taking that money out, they're at a lower income number, which might give them more flexibility on some other planning topics 30 years from now. So from a big picture planning standpoint, I would probably make the case here that Roth still makes more sense than traditional. But from a pure dollars and math standpoint, the tax rate makes it so that if you're in the same rate when you put the money in and take the money out, there's no mathematical difference in how much money you're going to end up with. However, that math problem changes when the tax rate when you're putting the money in is different than the tax rate when you're taking the money out. So what we're going to look at here is a scenario where Bailey had a bad year and is only in the 12% tax bracket. So if they put the money into a Roth IRA, they've got to pay 12% in taxes. They're able to get $8,800 invested. After 30 years, it grows to, call it $141,000. Compared to if they put that money in a traditional IRA, they don't have to pay any taxes, so they get more money invested. It grows for 30 years. But then when Bailey's retired, back in the 22% tax bracket. So now we take that 160 out, pay 22% in taxes, and we've got that 125 number that we're familiar with, right? So in this situation, Bailey had a bad year of income, chose to make a Roth contribution rather than a traditional one, and is going to be rewarded with an extra $16,000 extra dollars after tax in retirement because of making that decision. Okay. And that's just 1 year, $10,000. You can imagine how that compounds over time, making the right one versus the wrong one. And then last, we're going to look at when a traditional IRA might actually make more sense. So Bailey had a really good year. And even though they're over Roth income limits, there's plenty of ways to get around that. So they're looking at taking $10,000, putting it into a Roth. They pay the taxes. They're left with 68. That gets invested. That grows to $109,000. They take the money out. That's what it's worth. We compare that to if they had used the traditional IRA, they'd have gotten the full 10,000 invested. It grows. They take it out at 22%. And again, we're left with 125, a difference of about $16,000. So the takeaway should be that really when you're deciding traditional versus Roth, all it really comes down to is what tax bracket am I in when I put the money in? What tax bracket am I going to be in when I take the money out? And that's what's going to drive which decision is best for you in that moment. Obviously, there's a lot of guessing involved when it comes to what tax bracket you're going to be in 30 years from now. We won't get political here, but if you have to guess, most people, I bet I poll a room of 100, 99 would say taxes are going up. So that could be considered. The savings rate that you have is going to tell you a lot about what tax bracket you'll be in retirement. Maybe you have a pension or don't. Maybe you're going to inherit some money or you won't. And all of those things can help give us clues, at least, to the tax bracket you're going to be in 30 years from now. And that's where working with an advisor can kind of help you map some of those things out and start trying to hone in on what bracket am I going to be in when I'm taking this money out? What tax bracket am I in today? And therefore, where should I be putting my money today? So went through a lot there. Hopefully you guys found it helpful. I think the biggest thing that should come away from it is the amount of nuance when it comes to, I don't know what I'm going to make. I don't know what tax bracket I'm going to be in. I don't know how that's going to change month to month, quarter to quarter, year to year, decade to decade. The spreadsheet system doesn't work. You can't just go, okay, I make 150,000, I save 20% of my income and I forecast that out for 30 years and there's my financial plan, right? So the simple planning that somebody who's got a salary and that's it can do isn't going to work for somebody with a variable income. And a lot of the tools and things that are out there to help with planning simply aren't dynamic or nuanced enough to do a good job of that. So that's why working with an advisor or at least somebody that's got some experience in navigating the variable income planning is almost always going to get you a lot further than trying to guess your way along.
All right, we have some time to take some questions. I will let our participants know you're welcome to put some more questions in the
Yeah,
chat. I've already
please,
gathered
please
some.
do.
All right, our first question was a bit about bonuses and commissions. Are there higher taxes on bonuses and commissions? Can you talk a little bit about how that works?
Yeah, so that is a misnomer. A lot of people think that there's a different tax rate. Uh, it's because it feels like there is usually, because if you're getting a big bonus or commission, it probably means that it's stacking you up into higher tax brackets. So it feels like you're paying more taxes on bonuses and commissions. It's because you are, but it's not because bonuses and commissions fall under some other tax system. It's just because those are pushing you into higher tax brackets than maybe your base income originally was. Some other components to that are sometimes companies themselves will actually have a different withholding strategy for bonuses and commissions versus salary. So even though you're not actually paying more in taxes, it might feel like it at the time, and then maybe you get a bigger refund because of it, or maybe they're not withholding enough and you end up owing at the end of the year, so you feel like you paid more. So the answer is no. They don't get taxed any differently, but depending on where it pushes your tax brackets and how your company's withholding, it might feel a lot different. The only exception to that is if some of those commissions or bonuses are coming as 1099 rather than W-2. And so that you end up exposed to self-employment taxes in those numbers, which getting into the weeds a little bit, but long story short, if it's self-employment, you end up paying an extra 7.5% or so in Medicare and Social Security. But if you file a QBI deduction, then you can get a good chunk of that back if you've got the right business and it works. So if it's 1099, you actually might be paying more in taxes. If it's W-2 bonus or commissions, you're not paying any different tax rate than you would if that money came in as a salary.
All right, we did have a question about some international equivalents to these. And I will say that we are only focused on the US. So unfortunately, we can't really answer those questions, but we do encourage you to do some research on that in your country there.
Yeah, principles are the same, rules are different, right? You can take all the same principles and apply them. It's just a matter of understanding UK tax code and what accounts are at your disposal.
All right. If you are going to start doing this type of system, what's the best way to accelerate that savings cushion that you need to have in order to start your system?
Save more money, right? That is, there's no cheat code to building up a savings. It's a simple math equation of money in, money out, what's left over. That's how quick you're going to grow. Now, there is some nuance to if you're getting out of debt, what's the right way to do it to speed that process up. But I think the most important thing you can do is be accountable and aware of what you're spending every month. If you haven't done that, you'll probably be a little bit disgusted with yourself when you realize how much money was spent on Postmates or at the bar or whatever your vice is, right? Everybody's got one. It's just different for everybody. And if you look at that monthly on a number on a monthly basis, you're way more likely to change it. So I don't think you have to get carried away with budget if that's not in your nature, but at least once a month to go look over all your bank and credit card statements and go, okay, how much did I spend and where did I spend it? That's the best place to start.
All right. Can you talk to someone who, we had a question about this, who has a very seasonal business? So they're looking at lots of zeros in a row and then all of their money coming in, say 3 to 4 months in a year?
Yeah, so I think the place you have to start there is actually with an annual budget and make sure that the annual budget balances out. Because if your annual budget is in a deficit, it doesn't really matter what you do month to month. You're still going to have that deficit at the end of the year. So the best thing where this process can help you is if you do the annual budget and you feel like there should be a surplus 10, 20, 30, 40, 50,000, 100, whatever the number is, but then you get to the end of the year and that number's never there, that's where this process can really help you to go, okay, what am I doing? Where is that money kind of leaking out of the plan? So I think you have to start with an annual budget. And then also you're probably going to need a larger savings cushion than somebody with less variability would. So you might have to bump that savings cushion all the way up to 9 or 12 months of expenses to account for that.
All right. And then a final question here. Can you talk about how I could open up a SEP IRA or a solo 401k? I'm assuming they have some 1099 income or have their own business.
Yeah, so the SEP IRA is super easy. It's literally like going and opening any other IRA. So you could go to Fidelity or Vanguard or whoever it is, and you just title your account as a SEP. You're going to need self-employment income to contribute to that. So you get yourself in trouble because Vanguard, Fidelity, whoever it is, they're not going to fact check you on that. They're going to let you put the money in. And then it's going to be the IRS that fact checks you on it and goes, dude, you put $30,000 in here. You didn't make enough money to do that, or you didn't have any self-employment income. And then you end up with taxes and penalties and all that. So you have to have self-employment income. The rule is 25% of your self-employment income is what you're allowed to put into a SEP up to certain limits. But it's really easy to open and fund. It's just you've got to pay attention to what you're doing and not end up costing yourself more in taxes than you were trying to save. The solo K is a lot more nuanced. There's reporting requirements. I honestly don't think there's a responsible way to set up a solo K without working with an advisor or tax person to do that.
All right. And then one more question came in. I want to cover this one. Can you recommend any apps or tools to help with recording and tracking your variable income? I know you used a spreadsheet, but say if you wanted to use something on your phone.
Yeah, so I think something like the spreadsheet is less for the month, like the individual line items, as it is that bigger planning system. So that column on the far right for what am I going to do in the big months, that's probably the most important part of that spreadsheet. That column on the right there is really the only way I know is to have it built in a spreadsheet. The rest of your budget, I mean, there's a million good ones out there. It's just a matter of, so whether it's a NerdWallet thing or Mint or the list goes on, I honestly don't think any of them are better or worse. It's just people have preferences on what they want to load in and what they don't. They're all kind of a pain in the butt to get started because you've got to get everything linked up and you've got to properly identify, when I spend money here, it's this kind of expense. When I spend money there, it's this kind of expense. Does your Walgreens money go into healthcare or does it go into food and beverage, right? So there's all the setup. There's no getting around it. I wish there was an easier, better answer. The first month or 2 or 3 of setting up a budgeting app is probably going to kind of suck. But once you get past that, it's super easy from there, right? So you just got to kind of bite the bullet and get through the pain of the first month or 2. And it's going to help you a bunch once you get that done.
Well, that's about all the time we have for questions today. We want to thank our attendees for being so interactive. We want to thank Alex for being here and for the organizations that have made this webinar possible today. To our attendees, look for an email soon with a link to the replay of this event, and you're welcome to share that replay with friends and family. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again, from Advice Chaser, thank you so much for coming, and we will see you at another webinar soon. Goodbye, everyone.